Well, today I have with me Richard Dahl, Investment Committee Chairman at FMD, and Mike Reynolds, a Director and Investment Committee Member. What we hope to do today is just have a quick look at the impacts of COVID-19 on the financial markets, review what's happened to date, understand a little bit about how our portfolios have responded and performed in this environment, what action we've taken since the crisis has commenced, and also have a little bit of a look at the outlook whilst it's hard to predict, look into the future a bit and see what we can see. So Richard, first up, every crisis is unprecedented, but what's happened this time?
This time the crisis that's come upon us is very, very quick. Most crises, when they come, there'll be investor sentiment in the market, will take the market down. But the pandemic we've had now has spread so quickly and so widely that markets have fallen 30-40% in a month.
I think from an investment committee point of view, we expected to see some volatility in markets in 2020 calendar year. No one expected that the result of it would be from a pandemic, but clearly in the lead up to sort of early January, when China articulated to the market that they had a pneumonia-like illness that was not specifically diagnosed, I think world markets were pretty complacent in their behaviour, and markets really took it in its stride. And then when we started to see the spread around the world and governments scrambling to, start and put social distancing policies in place, markets then became really very aware of the fact that earnings and business activity just basically stopped overnight, and markets, like they always do, they panic, and that's what we've seen happen.
And so it came upon us very quickly, which really meant in the first instance we didn't have the opportunity to adjust portfolios. Richard, how did the portfolios stand up to the quick onset of this impact?
2019 was an unusual year for markets in that, with very low interest rates prevailing around the world, money was flowing into financial markets. Share markets were running at all-time highs, valuations were stretched. So the investment committee was looking at this through last year, and the returns from the AMS strategies were very robust, but markets were still running way ahead of expectations. So the FMD investment committee took action later in the year to put some risk management strategies in place, not envisaging a pandemic, but envisaging at some stage a retraction in markets. So when we came into February 2020, when markets started to react to the spread of the virus, the AMS strategies were well positioned already from what we put in place. So what had happened very quickly, too quickly to take other action. What we found as we got to the end of March, the AMS strategies had come through a very volatile period very well.
And Mike, what were some of those changes that were made last year in anticipation of some form of pullback?
We deployed three specific strategies. We reduced our equity exposure last year, effectively taking some profits at as Richard said, elevated prices. We introduced some longer dated government bonds into the market. And I think last year we articulated to our clients that we should have done that earlier. Hindsight's one of those wonderful things. We would have liked to have had a longer exposure to bonds at an earlier stage, but that for a number of reasons didn't occur. But we saw quite clearly on the world that governments were now in an easing progress, so in an easing phase where interest rates were being cut. So we wanted to ensure that if equity markets rolled over, we had some protection, which bonds are truly the asset that always protects you when equity markets fall. So bonds exposure, and we also introduced some gold into portfolios. Governments have been printing money now for some time, and historically gold is always a hard asset that protects portfolios in times of volatility, and we've seen gold prices in US dollars at 7-year highs and our Aussie dollar all-time highs. So it's been those three things, and the maintenance of our exposure to alternative assets, which are traditionally non-correlated to the share market, have all been things that have contributed meaningfully to our portfolios and protected our downside to some degree.
Yeah, and I think that's one of the things that I've observed looking at the portfolio performance versus benchmarks and the ASX is that what you guys would call our drawdown rate has been very, very muted compared to other portfolios in the market. And is that attributable to those decisions that we've made?
When we look back on all past periods, the portfolios have been designed specifically to maximise return for given levels of risk or market volatility. And so we've seen in all past times when markets have fallen, by design, the portfolios cushion the blow of the market downturn. And that's what our clients want. They want a smoother ride through markets. So we've found ourselves through all past periods travelling quite well through downturns. And when this downturn came, again, like Mike said, we already had existing strategies in place that have been there for the long term, like alternative strategies, good diversification, but we had some additional risk management as well. And the Zenith data showing at the end of March that the FMD AMS strategies have performed relatively very well compared to other strategies.
I think just with that, it's not just a phenomenon that's been specific to this circumstance in the market. I mean, we've always managed clients' portfolios on a conservative basis, and last year I think is probably an example. Our AMS portfolios had probably underperformed the market when equity markets were running hot, and we were probably a little frustrated around that. But we also knew that if markets did have a period of volatility, that we were well positioned to protect the downside, and I think that's vitally important for clients, particularly with a big part of our client base being pensioners and retirees. They're not still working. They don't have the ability to refresh or top up their portfolios because they're not working anymore. And so downside risk management is a key part of what the investment committee's charter is about.
Yeah, and Mike and Richard, I know that when you're assessing managers, one of the key things that we assess them on is, living up to their label and doing what they say they're going to do. And I think this is an example where our funds and our portfolios have delivered on our promise to our clients, which, whilst we've gone down, has been a very good thing. I wanted to move on a little bit. Whilst I think we've acknowledged that the timing of this was very quick, and we positioned our portfolios last year for a downturn, not expecting something of this magnitude. What have we done since then, working with our managers and with our investment committee to make sure that we're continuing to respond and manage effectively?
While we were very comfortable ourselves, we had the discussion with our researchers that the portfolios had come through quite well. It was really incumbent upon us to do thorough due diligence on every manager and bring our research consultants into that discussion to look through and see were there any risks that we didn't see, or would there be any risks in the future that may come up as a result of the change in the world. Because with this pandemic, the economic slowdown, things will be different. Certain companies before, which were doing well, may not do so well in the future. So we wanted to do a forensic overview of the portfolios, each of the managers with our researchers. So we asked Zenith to give us a dissertation on each manager, and we also sent out a questionnaire to each manager on how they'd performed through the downturn, where their portfolios were positioned for the future, what changes they'd made, and importantly, their own business operations. Were there any changes there as a result, or they foresee any? We went through that with Zenith, and we've come through that due diligence process. We've concluded that we do not have any unintended risks in the portfolio. We're very comfortable with how they sit.
Great. And so we're confident that we've we're well positioned at the moment. What are the scenarios, the way this might play out? Mike, do you want to perhaps explore some of the scenarios that we're considering and how this might play out?
So one of the things that we've done in this is that our international equity portfolios have basically been unhedged. So what that means is as the Australian dollar has fallen, we've protected clients' portfolios we've protected clients' portfolios on the downside of the fall in equity values because our dollar has actually cushioned that blow. So our Australian dollar was trading at 70 cents. It traded at the low down to nearly 55 cents. It's about 63 cents US today. And our intention at a committee level will be to rotate some of that hedging back so as we ultimately get to a neutral position. So by that it means 50% unhedged, 50% hedged. And so I suspect that if markets do recover, well, markets will recover, just about how long it happens, that our Aussie dollar is likely to rise in value against the US dollar, and we don't want to unwind what we captured on the way down. So that is one thing that we're working towards doing. The next logical step in the process from an IC perspective will be to take some profits out of our bond positions. So we've made money on the downside as interest rates have fallen, and look to maybe rotate a little bit of that money back into our underweight equities position, clearly at prices lower than where they were 6 weeks ago, but not quite yet.
Not quite yet, yes. Yes, and that's the difficulty, isn't it? I mean, we know that there's a possibility of the expression, Richard, dead cat bounce. We've had some huge upswing days recently in the market. How is the investment committee looking at these things?
Since we're in the bottom of the market on the 23rd of March, the flurry of information or negative news out there it's just been coming at us. Yet what has happened at the start of April through end of March, markets have rallied more than 15%. Maybe optimistic, extrapolating the restriction and the spread of the virus, what the economic stimulus is doing to offset the suppression. But it's a volatile time, and they could be dead cat bounces, you say, Lee. They could be green shoots. It's very hard to know. But the investment committee sort of expects bouts of volatility as sentiment ebbs and flows over the coming period. But what will be coming through will be economic numbers which don't look very good at all, and they've started to come out of the US. That's an expectation. It's when those economic numbers start looking, there's some improvement or some stability in the numbers, markets will start moving, and those are the signs when we will be having a look at those things that Mike was talking about, the reversal of those things, Lee.
I think that, Lee, the biggest issue that markets struggle with is uncertainty. So where we are today is the traditional measure of valuation of companies from an equities perspective is price and earnings. And so the thing that we don't know now is what the E is in earnings, because you've had so many companies that all of a sudden, in the travel industry, for example, tourism industry, hospitality industry, their earnings have basically gone to zero overnight. And how long that takes to recover, does it get back to the same levels beyond the pandemic, or does the market sort of disregard what is going on and looks way beyond where valuations can get back to where they were? The government's behaviours around the world, where they've just printed unlimited amounts of money to provide support to get beyond this, is absolutely unprecedented. As getting sick of hearing that word unprecedented, I must say. But governments have just printed money to try and give us enough time for their medical systems to cope, and for businesses to survive in order to be able to get back to the other side. And that's the uncertainty that's difficult to quantify from here.
Australia famously has avoided a recession for nearly 3 decades. What's the chances of us avoiding a recession now?
Neil?
And this is the conundrum from investors. Markets may not necessarily punish investment markets much further because a lot of that downside may already be priced into where we've fallen from. And because interest rates are so low around the world, investing is a relative game. So the cost of money is now zero, effectively. And so if you maintain your investments 100% in cash or defensive assets, well, you cannot generate an acceptable rate of return on your money and you spend your own capital. And so consequently, markets will be looking way beyond where we are now for this as an opportunity to invest in the long term. And we've already sort of started to see that in some particular resilient stocks that have held up pretty well. CSL, in the serum laboratory business is virtually unchanged price-wise from where it was. So I think, as Warren Buffett always says, I want to be fearful when others are greedy, and I want to be greedy when others are fearful. If you look back at the history of I've been in this industry now 34 years and been through a number of these events. History always says that when you have a massive bear market, it is always a good opportunity to invest in, but it's always difficult to pick exactly where your entry point is.
That says a couple of things, doesn't it? One is that investment markets typically lead the economy that we all have to live in. And so whilst there could be a recession, we could have most of the damage done to the investment markets already.
I think so.
Yeah. And the upside is closer in investment markets than perhaps in the real economy.
Investment markets will lead out first and well ahead of economic changes.
Share markets, Benjamin Graham, the famous investor from the turn of last century, described share markets as weighing machines. They sort of weigh sentiment for positive and negativeness, and clearly when markets sell off like this is that everyone's heading to the exits, and those on the other side of it have to then absorb the herd and to then build a position from which the sentiment then reverses. And we may be fully through that process, we might be partially through the process, or we might have another leg down. And that's why, from an investment committee point of view, we're patient to sit and wait, determine when we're confident that opportunities now look attractive enough, and that's the point that we will make those adjustments, which we discussed previously.
Great. Richard, are there any other points that you'd like to cover today that we haven't addressed for our clients?
I think the message is, like Mike was saying, that we don't have a sense of how long it's going to take us to get through this process. But the portfolio construction is that robust. It's been through past periods of time where it will come through the other end. And we've also already have in place some good risk management, additional strategies to unwind and to give the portfolio impetus in the future. So I think clients should sort of, and most clients we've spoken to have been pleasantly surprised how the portfolios have travelled through this period of extreme volatility. I mean, we're only talking 6 weeks ago, isn't it?
Yeah.
I mean, this 6 weeks ago, there we were where markets, the All Ords was up at 7,200. And then it went down to 4,400 in rapid time. So there could be a fair way further in the journey to go, but we're patient. The investment committee's got the experience and been through cycles before, so clients should be comfortable that we're navigating their portfolios prudently through this difficult time.
I think Richard's summarised that perfectly. We're experienced, been through this before. Every crisis is the same, but different at the same time. The cause is always different. It's always the cause that you don't see that really rocks markets. But markets typically behave in exactly the same way: fear and greed, and that's where that's where we try to navigate our way through this without taking unnecessary risks.
Well, look, I'd like to thank you both for joining me in this today. Mike, from your remote location, and Richard, now I'm very pleased that you're out of quarantine and able to just be in isolation. And also it's great to hear from both of you on what the investment committee's been doing and the performance of the portfolios, and also, whilst there remains uncertainty, the level of confidence that you have that our process is continuing to deliver for our clients. Is there anything else you'd like to add, Richard?
Look, I hope all our clients and their families are keeping safe and looking after their health. That's the most important thing. Ahead of that, let us worry about the investment markets and economics. Hope you're all safe, and we'll see you through the other part of this crisis. We'll get there.